Hey everybody, welcome back to our channel, The Real Estate Minds. My name is Ahmed Al-Sharifi, and today I'm going to be discussing a topic which is relevant for business owners. So if you're a business owner, then this topic might be discussing a solution for the challenges that you might be having in acquiring financing for real estate purchases. You know, I've always wondered why it was more difficult for self-employed individuals to acquire financing, but now that I'm a mortgage agent and I understand the process and policies that are involved with acquiring financing, I want to share this topic with you and inform you on the different reasons as to why this is the case, and also how to work around it. Before we get into all that, make sure you subscribe, like, and comment on this video. And stay tuned for more videos like this, as we will be creating a lot of real estate and finance related content moving forward. Now, if you're a business owner or you're self-employed or you fall under the category of a fluctuating income, meaning you are paid through commissions or you're paid through dividends or through investment income, then you've probably experienced the constant struggle of trying to maximize your tax write-offs by reducing the claimed income that you have on paper and maximizing your income to maximize the amount that you're able to borrow. I know it's a little bit complicated, but if you're a business owner, you probably understand what I'm saying. So what if you're somebody that wants to do both? What if you want to maximize your tax savings, but also want to maximize the amount that you're able to qualify for from a mortgage perspective? Before we get into all that, I want to mention something that's pretty crazy to think about. Let's say that there's two individuals that are getting a mortgage, and these two individuals work for the same company. The first person is simply an employee of this company who earns his income via a salary that's paid to him. The other person that's getting the mortgage is the owner of this company, and this person generates his income through business revenue. Who do you think would have an easier time getting the mortgage? You'd be surprised to know that the individual who's employed for the company would have an easier time getting a mortgage than the business owner who owns that very same company. Why does this happen? Well, for starters, it's the fluctuating nature of the income that comes with being self-employed. This makes it difficult for banks and lenders to assess your ability to repay the loan. Also, lenders want to see an extensive tax history and other documents of that sort. As we said before, most business owners or self-employed individuals are writing off most of their income to maximize their tax saving, and so their income doesn't look very good on paper. Unlike our friends who just get their paychecks every month and receive a salary, there isn't really much write-offs that they're able to do. And so their income is pretty consistent on paper. And so unfortunately, a lot of these savvy solutions that many business owners use to save on taxes end up working against them when it comes time for qualifying for a mortgage. And so for these reasons, banks and lenders typically look at self-employed income as being more risky. This can sometimes lead to getting higher interest rates and sometimes even a flat out no from the bank, unless you structure it in the correct way. Now let's talk about the solution. Let's talk about different aspects and different ways that self-employed individuals can navigate this process successfully. Well, for starters, as a business owner, you want to maintain detailed and extensive financial records. You want to do this for your own sake, but you also want to be able to do it so that you can share it with potential lenders that are reviewing your application. You want to obviously set up a business bank account that shows all income that's coming in and also expenses that are being paid throughout the year. Try to the best of your ability to centralize all business finances in one account. This can potentially open the door for a policy which is offered by some lenders, which is known as the business for self or stated income policy. In this scenario, a lender would simply want to see 12 months of bank statement records, which would show business income deposits being made into that account, as well as business expenses being taken out of that account. From that point on, they add up all the income, they add up all of the expenses, and whatever is left after the expenses are subtracted from the gross income is what we would use to qualify for your mortgage application. The good thing is we don't have to review your tax documents, meaning whatever you write off during tax season is completely separated. You would have the ability to fully maximize the amount that you're able to qualify for a mortgage, while also maximizing your tax write-off. Something like this is typically only offered on the alternative financing side, meaning it would typically come with slightly higher interest rates, a 1% lender fee, and a requirement to pay 20% as your down payment for whatever purchase you're taking on. But if you keep in mind the fact that you can still maximize your tax write-offs and save money on your taxes, then the cost actually might be justified for certain people. This policy requires a very organized individual, and it requires a centralized bank account which can show income deposits and expenses being drawn out. Another thing that you could do if you are a business owner is show consistent income. Even if it's not a regular paycheck, showing consistent income can positively impact your credit application. So if you are a business owner, think about paying yourself a reoccurring salary. Another thing that you want to do if you're a self-employed person, although this applies to everybody that's looking to acquire financing, is you want to improve your credit score. It goes without saying why you should maintain your credit history, because of course it can make the difference between qualifying for a little bit more to get the deal done. And also it can make the difference between getting the better rate versus the worst rate. Also, if you're a business owner, you want to save as much money for your down payment as possible. Saving up at least 20% for your down payment will open up so many doors for you and will allow you to take advantage of many creative financing solutions that will allow you to maximize your borrowing power and purchase the home of your dreams. So there you have it. The mortgage game for self-employed individuals is tough, but there are solutions that can make it work. By maintaining your financial record, showing consistent income, maintaining a strong credit bureau score, and saving for a larger down payment, you can put yourself in the best position to maximize your borrowing power and increase your chances of being able to purchase that house that you want to purchase. Don't let the complexities of mortgage financing discourage you from making the real estate investment that you want to make. With the right approach and the right team around you, it can be done. And that's a wrap for today. I hope you found this video insightful. If you would like to set up a time to book a consultation with me to discuss your specific and unique situation, click the link in the description box below to set up a call with me.